Here at Optivest, our one and only job is to protect retail shareholders by looking past the glossy brochures and getting to the truth. Today, our forensic lens is zeroed in on the Kingsbury PLC. Now, it sells itself as this impenetrable fortress of luxury, but you have to ask, are its walls built on solid rock, or is it all just shifting sand? So, let's crack open the numbers and find out what's really going on.
And there it is, the Kingsbury. I mean, it's an icon. A premier five-star hotel with 229 rooms and, get this, 10 different culinary venues. It really is a monument to luxury right in the heart of Sri Lanka's commercial capital. And for years, pretty much everyone has seen it as this unbreachable fortress in Colombo's hospitality scene.
But, every fortress eventually gets tested. And back in 2022, the Kingsbury faced its biggest test yet, an economic storm so furious it brought the entire nation to its knees.
What's absolutely mind-boggling here is just how fast everything fell apart. I mean, we're talking about a matter of months. The country went from dealing with shortages to a full-blown sovereign debt default. This wasn't just some little economic dip. It sparked a complete political meltdown that ended with both the prime minister and the president resigning. And this chart, wow, it just lays out the scale of that damage perfectly. The GDP shrank by nearly 8%. Inflation shot up to almost 50%, and foreign debt hit an insane $58.8 billion. And the hospitality sector, which relies completely on tourism and people having money to spend, was right at the epicenter of this economic earthquake.
So, with the whole country in chaos, you think a luxury hotel would be the first thing to crumble, right? Well, this is where the story takes a fascinating turn. The Kingsbury didn't just survive, it actually launched a pretty stunning counterattack.
Okay, just look at these numbers with me for a second. Revenue went up a tiny bit, just 1%, but that's not the real story. The story that matters to us as investors is the profitability. Profit after tax more than doubled. It exploded by 109%, and earnings per share did the same, jumping 107%. On top of all that, management actually cut total debt by 16%. This isn't just about surviving, this is a masterclass in how to run a business.
Now, let's zoom in on the single most important number on the board for us as shareholders, 33.75%. That's the Kingsbury's return on equity, or ROE. To put it simply, for every 100 rupees of shareholder money in the company, the management generated almost 34 rupees in profit. A number that high isn't just good, it's absolutely exceptional. And it's our first big clue about where this fortress gets its strength.
So, that leads to the obvious next question in our investigation. How on earth did they pull that off? What's the secret sauce? Well, the answer lies in a concept that every single serious investor needs to understand: the economic moat.
The idea, which Warren Buffett made famous, is actually really simple. The best businesses have a moat around them, some kind of durable competitive advantage that keeps all the rivals away, just like a moat protects a castle. For the Kingsbury, that incredible return on equity we just saw, that's a direct result of its powerful, two-tiered economic moat. Our forensic analysis found two key layers to their defenses. First, total and complete culinary dominance. Food and beverage isn't just some side business for them, it's the heart of their strategy, and it's made them the #1 place to eat in Colombo. And second, an unbeatable strategic location, right in the middle of everything, business, culture, you name it.
And this is the real key. Think back to that crisis in 2022. International tourism disappeared overnight. So what happened? Their food and beverage business became their tactical life jacket. It was their loyal, local customers, the people who kept coming back day after day for the amazing dining, that anchored the entire business and let it power right through the storm.
So the fortress survived the economic storm. But as they say, the reward for winning one battle is just another battle. And now, a whole new, formidable army of competitors is marching on Colombo. This siege is going to be different.
Which brings us to the biggest question for anyone who owns this stock or is thinking about it. The last fight was against a huge economic crisis. This next fight is against a wave of powerful, direct competitors. Can the walls hold up a second time?
So let's break down this invading army. First, you've got a massive, over 30% jump in the number of five-star rooms in the city. Then you have these new, smaller players like La Maison de Colombo trying to steal the high-end, niche customers. And here's the real game changer. The government just got rid of the minimum room rate policy. That means a brutal, all-out price war isn't just possible anymore, it's pretty much guaranteed. And then there's the Titan, the $1.2 billion City of Dreams. Just listen to this quote from the chairperson of John Keel's. They're not just building another hotel here, they're trying to set a new benchmark in South Asia. With 800 rooms, a casino, and high-end shopping, this is a threat on a scale that Kingsbury has never, ever seen before.
All this new pressure exposes what our analysis shows is a core structural vulnerability in the business, forcing us to ask the most critical question of this entire investigation.
How can a company create long-term compounding growth when it only owns and operates one single asset? This is the fundamental problem. A fortress can be incredibly strong, but if it only has one tower, its reach is always going to be limited.
Yeah, and this slide just lays out the dilemma perfectly. Big hotel chains can grow by building new hotels, buying up their competitors, or expanding into different countries. The Kingsbury can't do any of that. Its number of rooms is fixed. Its restaurant capacity has a limit. All of its future growth has to come from internal optimization, from squeezing more and more revenue out of the exact same physical building.
So what this all boils down to is that the company's path forward is all about efficiency, not expansion. They have to run an absolutely perfect operation, maximizing every single room, every room rate, and every restaurant bill, because building another tower simply is not an option.
And this brings us to our final, parting question for you, the retail shareholder. We've seen this fortress prove how strong it is against a total economic collapse. But now, with giants like City of Dreams knocking at the gates and a hard limit on its ability to physically grow, you have to ask yourself, is its amazing culinary moat really enough to defend its profits and its crown in this new, brutal era of competition? That is the core question you have to answer.